Hello and welcome to another episode of Darwin Investors. Well, I guess I'm a little bit late putting out a video this weekend. Sorry about that, folks. But in all honesty, I've been trying to catch up with the market because the wife and I, we've been on vacation this past week in Boston. And then since returning from vacation, we've been trying to stage the house and sell the cars because we're planning a move back to England. And that's where I'm going to be kind of semi-retired. And eventually I'm going to retire in England. And I'll put out another short video about why I might be retiring in England, just in case anyone's interested. It'll be real short. I'll do it after this one. But like I said, last week, I was on vacation in Boston. And I wasn't really paying that close of attention to the market. However, I did pay close enough attention to the market to know that oil was doing really terrible, and my market week was actually really bad. But that was all despite the fact that the big tech stocks were moving higher, and all three major indices finished higher for the week. I just did terrible, and I was probably really due for a week like that one. I've been kind of getting away with it for like the last 4 months, being so heavily in these value stocks, plus just selling covered calls and puts and stuff like that has been making my portfolio really nice for the last few months. So, I was due for a week like this, and it won't be the last one. Probably overdue if I'm honest. Okay, well, enough of that. All right, so in this episode, what we'll be talking about is the upcoming FOMC meeting and the probability and implications of another rate hike. We'll also talk about the sudden rise in tech stocks, why that might be happening. And I've also been noticing in the comments, and thank you for the comments, by the way, just keep them coming. I love answering these things. But I've been noticing in the comments some chatter about oil and USOI and Credit Suisse. So I'm actually happy to weigh in on those topics. I guess I've kind of turned into the oil and USOI guy, haven't I? I really do like the oil stocks, if I'm honest, and that's because they have a great valuation. They pay a nice dividend. They're a great market hedge, through all of this volatility, as they have been until this past week. So I really do like the oil stocks as kind of like a bond proxy. Rather than buying bonds, I'm buying these energy stocks. And then I really do like USOI because you have that chance that you can make that big dividend and actually go up a little bit higher. But really, for me, that's just a cash proxy. I'm only going to be in this stuff until the market kind of turns around, and then I can get back into my normal stuff, which would be like Lowe's, UPS, Amazon, Google, so on. And so as soon as the market comes around and the Fed stops doing their thing, then I'll get back into those stocks. But for now, I'm in my bond proxies and my cash proxies, and I'm happy enough doing that. They've been doing me well right up until this past week. All right, before I go into the FOMC meeting and oil and USOI and all that stuff, really, I need to address the bank topic because really it is issue of the day, but I'm not gonna lie, it's really irritating to me when I'm starting to see chatter online. And these are people that actually have a lot of money. People like Ken Griffin saying that depositors shouldn't be getting their money back just because they have their money in these regional banks. And, I don't know if he knows this, but with digital banking, you can actually do a bank run now in just a few hours. It doesn't take, a week or a month or whatever, but like basically all of your life savings can disappear within just a few hours. And as far as I'm concerned, that's robbery. And I think that the government should be backstopping some of these deposits. And, these banks where they are doing the bank runs, these banks like First Republic and like Signature Bank in Silicon Valley, about 90% of these depositors are basically uninsured depositors. They have more than $250,000 in their savings. And so they're having to go in there and quickly get their money out because they're not FDIC insured, and the bank runs are happening. It's causing these banks to get into some real trouble. And I guess the expectation is that a lot of these depositors will know all of this stuff, but a lot of these people don't know this stuff. And so, what are we supposed to like dig into these, to whatever bank that you're going to deposit money into and look at their unrealized bond portfolio before you make a deposit? Or you just risk losing everything? And especially when these bonds right now are trading like meme stocks. The freaking 2-year went from 5% to 3.6% in like a week. I mean, how can we keep track of this stuff? This is worse than GameStop right now as these bonds. And depositors and bank managers are on the hook to try and figure all this stuff out. And you want to penalize these depositors for all the shenanigans going on at the Fed because they really don't know what they're doing. I'm just totally against that. I mean, you're putting your money into a bank. It's not a roulette wheel at Las Vegas where you expect to lose a lot of your, a lot of your money. You're not making a bet here. You're depositing money in a bank. And then, so do you really think if you start taking all these money from some of these smaller regional banks that wouldn't eventually spill over to a lot of larger banks? Well, of course it would. This would just cause a crisis, just a whole banking crisis, whole financial crisis in general. Not just the United States. We're finding out that this just happens the world over. It happens here. It seems to affect the planet in some way. And so, of course, it had to be backstopped, and these depositors should get their money. If you're going to pay for people that are signing a contract that they're going to pay back their college loan, and you're going to give them forgiveness, at least give the dang depositors back their money because they earned it. And these regional banks, they weren't exactly investing in SPACs. We're talking about U.S. Treasuries and mortgage-backed securities. Are they going under just because of some poor management, from some bank manager? I mean, maybe to some degree, but let's go ahead and look at this chart and see if there was anything they could do about this. What we're looking at here in this chart is the change in the federal funds rate. And what we can see is in 2022, we went from about 0.25% up to about 4.5%. If you look along the x-axis here, in about 12 months. And this was the steepest, highest, fastest rise in history. The next closest would have been 0.25 to about 3.25 in 88, 89. That also happened in about 12 months. And after that, we're looking at 2004 to 2006. We went from 0.25 to about 4.25 in roughly 24 months. And this is what we're expecting these bank managers to compete with. So when you look at this chart here, you've got a bank that maybe invested in, say, commercial real estate a few years ago, 10-year treasuries a few years ago when it was at like 1.5% return. And now all of a sudden, they're staring at billions of dollars of unrealized losses on their balance sheets. They're giving out about 0.5% on their savings account, and they're having to compete with the Fed, who's giving out 5% on 2-year treasury notes. And these guys are staring at these losses saying, hey, if we don't crank it up to at least here, we're going to lose depositors. Then we're going to have to realize all these losses on our balance sheet, putting our bank underwater. And the Fed, in the meantime, is saying, oh, well, we got to go ahead and still keep up cranking up interest rates at this next FOMC meeting 0.25 point because we've got to keep our credibility. And, I've said this before, but you get credibility through competence. And them putting these banks underwater, that isn't credible. That's showing incompetence. You want to show competence, well, then do something with real-time data. You don't have to tighten any further. You've already ground this economy to a halt. These banks are in no position to be lending out money to people right now. You did it. You've tightened. There's no reason to raise these rates any higher. And this guy, Rosengren, he said it better than anybody else in a tweet. His tweet said, financial crises create demand destruction. Banks reduce credit availability. They cannot loan. They are basically now just trying to keep the doors open by making sure their depositors don't run off and put their money into money market accounts or buy 2-year U.S. treasuries. The consumers hold off on large purchases because they can't get loans. Businesses defer spending. Interest rates should pause until the degree of demand destruction can be evaluated. And who is Eric Rosengren? Well, he was the president and CEO of the Federal Reserve Bank of Boston until he retired on September 30th, 2021. And until then, he was a participant and voting member of the FOMC. Where is this guy right now? This is what the FOMC needs. What they need is somebody in the room that says, hey, cut this out. We've done enough. Maybe this guy can come back out of retirement. Instead, what we're going to do is we're going to look at some bogus CPI print showing that rents are going up and housing values are going up off the charts, causing inflation to still stay sticky, which, by the way, I can't stand that. Inflation's been sticky for about, I don't know, 400 years. But keep inflation sticky. And so it's not coming down as fast as we like, but they're doing it based on this lagging housing data. And I think we all know this. Of course, the Fed knows this. Let's go ahead and have a look at a couple of these charts. Here's a chart, and this is irritating, by the way, folks. Here's a chart that shows the contribution of CPI, and we can see that CPI is coming down in a straight line, sort of like my portfolio did last week. So it's coming down a straight line, but what the Fed says that they're interested in, or what they're most concerned with, is the fact that this blue line just keeps on going up, 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 and this is the services. Now, of this entire CPI read, about 40% of it is housing, and of this blue line, a much larger percent of that is housing, and a little bit of it is wage inflation. So let's go ahead and look to see what rents really have been doing and what wage inflation's been doing. So we can see, according to Redfin here, that rent growth has continued to slow in February. It actually peaked in March of 2022. So we're hiking right now based on data, believe it or not, that came out in March of 2022. It has been plunging ever since. But we're not looking at this data here. What the Fed is looking at is lagging data here to say that inflation is still on the rise. We need to keep on cranking up interest rates because inflation isn't coming down to the level that we would like. And when you look at another big portion of the services data that they like to reflect upon, which is wage inflation, we can see that the month-to-month percent change in real average hourly earnings has actually been going down since September of 22. So rents are coming down, wages are coming down. However, that services thing, that bar within the CPI read is awful large. They're saying we need to crush that. When the inflation rate was at 6%, then they were buying back $120 billion in mortgage-backed securities and U.S. treasuries every single month, turbocharging the housing market and sending out trillions of dollars worth of checks into people's bank accounts. And then they got to wonder why the inflation rate went up. And now they're going to bring it down so fast that they're causing bank failures. And now people are like, who do we blame? Do we blame the regional bank managers? Do we blame the depositors? No, you blame the Fed. They're the ones that have done this whole thing. And like it or not, the political party in power also gets the blame for bank failures because that's just the way it's always been, whether it's their fault or not. All right, and so what do you think that retail investors are doing with all of this information? Take a wild guess. They're buying the dip in financial stocks in unprecedented amounts. Now, look, I'm not a financial advisor and I'm not your dad, okay? I am a gambler at heart, but even I wouldn't be walking into this hornet's nest right now. But if you want to put your money into First Republic or KeyCorp or Comerica or who else is out there? Western Alliance or Pac West or whatever, be my guest. It's just where I'm not willing to put my money, but you may do it and get a 20 or 30% return real fast. And I must have been in a pretty bad mood when I made this presentation, it appears. Maybe it's all the cleaning that I've been doing, I'm not sure. But this is the day that actually kind of pushed, in my opinion, the banks over the edge. Now, I'm not saying it's the sole cause. I'm just saying it's that feather that landed on something that just kind of like made the whole thing collapse. And that was here on February 3rd when this jobs report showed an increase of 517,000 jobs in January, crushing estimates as unemployment rate hits a 53-year low. Oh no, people have jobs. Fed's going to crank up the funds rate again. And what that did was it sent the 2-year treasury right here on the second from about 4% all the way up to about 4.79%. And then, of course, Powell's got to do his thing in front of Congress, and we're going to hike higher for longer, and we're going to leave it there forever. Now, as these bond yields go up to 5%, the bond itself decreases in value. So as bond yields go up, the bond price goes down. And all of these unrealized losses on these bank portfolios were just stacking up. Then at the same time, there was this bank run, and now they have to pay back this bank run by cashing out an even more worthless portfolio, causing the banks to collapse. And when Silicon Valley Bank collapsed and later Signature Bank collapsed, it caused this rapid decline in interest rates because people are like, well, the Fed can't tighten anymore. But oddly enough, this bond collapse actually strengthened the portfolios of a lot of other banks. And maybe that's why retail investors are piling into retail stocks. But in any case, this was looked at, it says, well, the Fed can't possibly tighten anymore, or will they? So next week, they're about to have their FOMC meeting. And people are awaiting this Fed rate hike decision. And what is thought right now is that they are going to raise, they are expected to raise another quarter point next week. They don't need to raise. They should probably cut, if I'm honest, but they don't need to raise. But at the very least, they should do nothing. But right now, the odds for a quarter point rate hike are sitting about 70%. Now, a 25 basis point hike is the consensus view, but Goldman Sachs does disagree. They are expecting the Fed to pause next week. I hope Goldman Sachs is right. I don't think that they need to hike rates next week, but I've kind of lost all faith and confidence in the Fed. I think they are going to hike. I mean, oh, banks, whatever, interest rates, their balance sheets, who cares? We're going to hike up even more. But I had a bad week last week, but even with Friday's sell-off, the S&P 500 and NASDAQ scored gains for the week. The S&P 500 rose by 1.4%. The Dow was a slight loss at 0.2%, and the NASDAQ was up 4.4% as big cap tech stocks like Apple, Microsoft, and Alphabet drew in investors. And what's happening is that these big tech stocks are looking like safe havens. They got these fortress balance sheets. They've got tons of cash on hand. They looking like a safety play right now. Let's face it, big cap tech stocks are staples. I've been saying this forever on this channel. Do you think that Hershey's is a staple, or do you think that Microsoft is a staple? Can you give up on your Smucker's jelly, or can you give up on your Amazon? Which one would you give up first? Your Amazon Prime account, or are you going to stop buying jelly? You're going to give up your jelly, okay? Amazon is a staple, and these are looked at as safe haven plays right now because these are the companies that make all the money. I never understood why they were clobbered in the first place. But the other thing that's helping these tech companies out is when interest rates decline, tech company stocks, or what they're looking at as growth stocks, tend to go up in value. So as interest rates decline, growth stocks should continue to rise, and especially these mega cap tech stocks that are looked at as growth stocks that have a defensive quality about them because they are staples as well. So Apple and Microsoft were a record 13.5% of the S&P 500's cap on Friday morning. While other stocks sold off, Apple gained 4.4% for the week, and Microsoft and Alphabet were both 12.5% higher. If you've got those stocks in your portfolio, congratulations. I wish I did right now, but I don't. I've got ConocoPhillips, Advanced Auto Parts, and Chevron and other things. I don't remember everything. They're being treated as safety right now, says Sohn. It's rare to have any stock alone to have a weight of more than 6%. Schwab Saunders said the buying in big tech was a flight to safety within the sector itself. And they go on to argue that big tech a year ago had high valuations. They're saying it's better now, but it's still not cheap. But what I think is really interesting is this Peter Bookvar right here. And this is where he says, he's the chief investment officer of Oblique Financial. He says, tech does well if their customers do well, he said. If the U.S. economy is going into a recession, they're going to be buying less cloud service. They're going to be buying less software. People are buying these big cap tech names and they're not thinking this through. And he has a great point. It's because if companies can't get loans anymore because banks aren't lending money, especially smaller companies, how are they supposed to sell new cloud services to new companies? How is Microsoft supposed to up their value? How is Alphabet with their Google Cloud going to up their value? So he brings up a good point. I do see things reverting back to the way it was in 2022 if the Fed does keep on cranking up interest rates. However, if they do pause or cut, I can see where growth stocks would actually continue to rise despite what Peter Bookbar says, but I just don't think he's wrong. All right, I can tell this video is running pretty long, but before I go, let me go ahead and give a quick shout out to my oil peeps out there. I guess now I'm an oil baron. Okay, which I actually am now, I guess, if you look at my portfolio. And so let's go ahead and look at what is in store for oil before we call this a video. Oil prices settled down post big weekly losses on bank fears. And so the underlying fundamentals aren't as terrible as what is being priced in here, but there is concern the oil is not as safe a place as cash or gold. And I think this is interesting, the way oil is kind of looked at like, say, having your money in cash or having your money in some other market hedge like gold or possibly even these days Bitcoin. That's the way oil is kind of viewed. But for years, oil was like dragging behind the stock market because I think that people didn't really realize how valuable, as funny as this sounds, how valuable oil is to our economy still. They're like, oh, it's like the dinosaur, it's going to go away. It's not going away anytime soon. But people didn't really think that way. So it was always treating it at a market discount. So when you look here at the XLE, and let's look at this over, say, the past year, and we compare this to the price of, say, crude oil, we can see that over the past year, the blue line being the XLE, or basically the energy sector spider, all of the energy stocks that are in this ETF together have far outperformed oil. However, if you look at it over 5 years, you can see that they're pretty much just catching up to where, oil was up here, and they're just kind of catching up to where they've always should have been. And in a big way, I actually see this as like wages too, like wage inflation. They're like, oh, wages just keep going up, but it's usually, it's the bottom tier of wages that are coming up. That's what's driving the wage increase. And all that's happening now is that group, that cohort is like catching up to inflation in the same way that oil stocks are catching up to the price of crude, if that makes any sense. All right, so the bull case for oil is just largely intact. WTI's fall this week to less than $70 a barrel for the first time since December 21st could spur the U.S. government to start refilling its strategic petroleum reserves, boosting demand. And analysts expect China's demand recovery to add price support, with U.S. crude exports to China in March heading towards their highest in nearly 2.5 years. Saudi Arabia and Russia, in a meeting on Thursday, affirmed their commitment to OPEC Plus decision last October to cut production by 2 million barrels per day until the end of 2023. And OPEC Plus is due to meet on April 3rd, which they're going to do what? If the price of oil is crashing, I imagine they're going to be cutting more production targets, and that's going to send oil up a little bit. So that's going to do it for this week. So I think the Fed does have their work cut out for them this week. I think they paid themselves into a bit of a corner to where they can't say anything right. It's sort of like when I say something to my wife, and it can be interpreted two different ways, and one of the ways makes her really mad. I meant the other way. And so that's kind of where they are right now. It's sort of like if they don't hike at all, the market's like, I knew it, we're going into a recession, and that's going to set things down in a spiral. But if they do hike up 25 points, it's going to be like, I knew it, the banks are all going to collapse, and that's going to send things down. So I don't know what the right answer is with this. I don't think a 25 basis point hike is going to do anything to inflation. That being said, I'm sorry it's been so negative. I do still believe that the market is essentially just going to continue trading sideways like it has been since May, and it's going to continue doing, as far as I can tell, for the rest of this year. That's the reason why I'm in these oil stocks. That's the reason why I'm in USOI. I'm just trying to eke out little gains because I'm just trying to put my portfolio into bond proxies and cash proxies and trying to eke out a little bit while I wait this thing out. All right, so if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye. So all the banks are crashing in Europe right now. The stock market's in the tank. So what do? I go to a brewery, of course. I'm here in Boston, Massachusetts. We're here at the Harpoon Brewery. Just got lucky enough to get
here on a brewery tour. Got here with 5 minutes left. The gods are shining down on me, even if the stock market is not. I can't wait to get that tasting room. So right now we're in the original tasting room from Harpoon Brewery. This here is kind of like a secret room that you can't get unless you're lucky enough to get the tour here, which I just happened to get. Best $5 I ever spent. So then for $5 I was able to sample each one of these beers. Here I am on this tour. The stock market is crashing, but all is well. Back there against the wall you see the 100 barrel series. The 1.7 from the left is the Union Street Revival Ale. I pretty much drank 99 of those barrels. I would say that that beer is probably the only 6 Kate Rooney beer out of 5. And right over there you can see he's adding the hops to the beer. What you're doing right there is the boil. And so he's making himself maybe a Harpoon IPA. Harpoon IPA is the very first New England IPA made by Mitch Steele, who later went on to brew over at Stone. It's all Cascade, fantastic beer as well. Worth drinking. If you're here in Boston, make sure you get that beer. All right, now here I'm over here at Hurricanes Bar and Grill, which is right down the street here from the TD Arena. Hopefully I'm going to be watching a lot of March Madness today and making a lot more money with these basketball games than I ever did with the stock market this past week. Right now I am having a Harpoon IPA. You can find them on tap everywhere here in Boston. Cheers, everybody. And I give this beer 5 Kate Rooneys out of 5. Have a great day, everybody.